Hello everyone. Welcome to BYK Book Summary. I am Amin. Here we decode the inspiring journey, mental warfare, and empire building life lesson of the world's greatest legend. Today topics and their biggest secret are right on your screen. Let's dive in with my AI co-host.
I want you to picture a highly specific and honestly slightly absurd scenario for a second.
Okay, I am intrigued.
Imagine you take a completely ordinary monkey, like just a chimpanzee from the local zoo.
Right, standard monkey.
Yeah, exactly. And you hand that monkey a fistful of darts. Then you walk it over to this massive wall that is just plastered floor to ceiling with the financial pages of a major newspaper.
Oh, wow. Okay.
So we are talking thousands of stock listings, those ticker symbols in the tiny print just pinned up there covering every single inch of the drywall.
I can picture it.
And you just let the monkey throw those darts entirely at random. Whatever stocks the darts happen to puncture, you put those into an investment portfolio.
Okay.
Now, here's the million-dollar question. Or, I mean, really, considering the size of the asset management industry, the multi-trillion-dollar question.
Lay it on me.
Could that dart-throwing monkey build a portfolio that actually outperforms a highly paid, Ivy League-educated Wall Street hedge fund manager?
See, it sounds like a joke. It sounds like they kind of set up to a punchline designed to just, mock the financial industry at a cocktail party.
Right, it sounds totally made up.
But the premise is entirely serious.
Mm.
And the answer, when you actually look at the historical and statistical data, is profoundly unsettling for anyone who makes their living wearing a tailored suit in Lower Manhattan.
Right, because if the answer is yes, or even if it's just a statistical maybe, then what exactly are we as investors paying these professional analysts for?
Exactly.
Like, why are we handing over billions of dollars in management fees every single year? That tension, that deeply uncomfortable truth about the limitations of professional expertise is exactly what we're unpacking today in this deep dive.
It's a huge topic.
We're looking at a book that essentially took a sledgehammer to the traditional, highly lucrative Wall Street machine.
Yeah, a massive sledgehammer.
The book is called A Random Walk Down Wall Street, written by Princeton economics professor Burton Malkiel.
And we really need to contextualize just how enduring and honestly defiant this text is. Malkiel first published this book back in 1973.
1973.
Yeah, over 50 years ago. And it has sold over 1 million copies. It's gone through 13 different editions.
Yeah. Wow.
We are talking about 50 years of financial history, 50 years that included, the stagflation of the 70s, the Black Monday crash of 87.
The dot-com bubble.
The dot-com bubble, exactly.
Yeah.
The 2008 global financial crisis, and all those wild pandemic swings we just went through.
Right.
And through all of that, the core message of this book is still as structurally sound and arguably as controversial as the day the very first hardcover hit the shelves.
Okay, let's unpack this. Because Wall Street, as an entire industry, fundamentally sells complexity.
Oh, absolutely.
They sell the idea that the market is this dense mathematical labyrinth, right? And you need a highly paid guide to navigate it.
Yeah, they sell proprietary models, they sell quarterly forecasts, they sell basically the illusion of control.
Right, the illusion. But our mission today is to explore why simplicity isn't just like a cute alternative to that complexity. It is actually the ultimate winning strategy.
But it requires a radical, almost painful shift in perspective for most people.
How so?
Well, to accept Malkiel's premise, you have to actively unlearn almost everything the financial entertainment complex tells you on a daily basis.
You mean like the news networks?
Yeah, the financial news networks with their flashing red and green tickers, the glossy magazines, the talking heads shouting buy and sell ratings on TV.
Right, right.
They all operate on the baseline assumption that the market is a puzzle that can be solved. They assume that with the right strategy or, the right insider insight or the right expert, you can somehow beat the system.
And Malkiel just steps in and says the financial emperor is completely naked.
Basically, yes.
But before we can get into the mechanics of how to actually beat the experts at their own game, we have to understand the fundamental law of the market that these experts refuse to admit exists.
The random walk.
Exactly. It's right there in the title of the book, The Random Walk. Now, I understand the literal imagery, walking aimlessly, but what does that term actually mean in the context of global finance?
So the random walk theory is an incredibly powerful statistical concept when you apply it to price movements.
Okay.
In the context of stock prices, it states that market movements are statistically independent of past movements.
Meaning what, exactly?
Meaning what the stock price did yesterday, what it did last week, what it did over the previous quarter. Literally none of that historical data has any bearing whatsoever on what it will do tomorrow.
None at all.
None. Tomorrow's price change cannot be predicted by looking at today's price. The path the price takes is, quite literally, a random walk.
So it's governed by the same statistical laws as flipping a coin.
That's a great way to think about it.
Like if I flip a quarter and it comes up heads 10 times in a row, my human brain instantly tells me that tails is due.
Right, the gambler's fallacy.
Yeah, or conversely, it tells me the coin is, like, hot and will just keep rolling heads forever. But the physical coin doesn't have a memory.
No, it doesn't.
The 11th flip is still a pure 50-50 proposition. The previous 10 flips are statistically independent events that have zero physical influence on the present moment.
That is the exact mathematical principle. The coin does not know it just landed on heads 10 times. And the market, in terms of its daily price fluctuations, operates under a very similar mechanical reality.
Okay, break that down for me.
Sure. So the price of a stock at this very second already reflects all the current knowledge, all the earnings expectations, and all the macroeconomic fears about that specific company.
So everything is baked in.
Exactly. Therefore, the only thing that will cause the price to move tomorrow is new information.
Okay, that makes sense.
And by definition, new information is unpredictable. I mean, if it were predictable, it wouldn't be new information, right? It would already be known and factored into the price today.
Right.
Because the news of the future is random and unpredictable, the subsequent price movements reacting to that news must also be random and unpredictable.
I really want to focus on why this is so deeply controversial. Because when you explain the logic, like that future news is unknowable, therefore future prices are unknowable, it sounds entirely rational.
It's very logical.
But this idea is a direct existential threat to the entire value proposition of the professional investment industry.
Oh, it is a threat to their entire economic model.
Okay.
Think about the massive, towering infrastructure built around predicting the stock market.
It's huge.
You have tens of thousands of analysts, massive server farms processing petabytes of data, entire television networks broadcast in 24 hours a day,
All of them guessing.
all dedicated to the premise that analyzing past performance or current chart trends can somehow provide a reliable map of the future.
Wow.
If the random walk theory is correct, if past performance truly does not predict future results, then this entire billion-dollar apparatus serves absolutely no functional predictive purpose.
It makes me think of trying to navigate a ship.
A ship.
Yeah, trying to predict the stock market based on past prices, which is what a massive chunk of Wall Street essentially does, feels like trying to navigate a ship through an active, dangerous minefield by having the captain stare exclusively at the wake trailing behind the boat.
Oh, that's a brilliant analogy.
Right. The wake tells you exactly where you've been, it shows you all the turns you've made, but it tells you absolutely nothing about the explosive mines sitting 200 yards off the port bow.
And the market is constantly generating mines, sitting 200 yards off the bow.
Always.
A sudden shift in the Federal Reserve's interest rate policy, an unexpected geopolitical conflict, a global pandemic, a sudden breakthrough in artificial intelligence.
Stuff you can't see coming.
Your analysis of the ship's wake gives you a false sense of security, but it offers zero navigational utility for those sudden, violent shifts in the economic waters ahead.
Which naturally leads to a massive question.
Yeah.
If this book came out in 1973, and the underlying math regarding randomness holds up to scrutiny, why does this illusion persist 50 years later?
It's a fair question.
Why are you and I, as average investors, still so incredibly desperate to believe that some guy in a fleece vest on Wall Street has a crystal ball?
It fundamentally comes down to human psychology and, honestly, the sheer overwhelming marketing power of the financial industry.
Psychology how?
Well, the human brain is deeply biologically uncomfortable with uncertainty. Pure randomness is terrifying because it implies a total lack of control.
Yeah, we hate feeling out of control.
Exactly. So when a Wall Street expert goes on television and tells you they have a proprietary algorithmic model that predicts the market's next move, they aren't just selling you a financial product.
They're selling comfort.
They are selling you psychological comfort. They are selling you the illusion of order in a chaotic, unpredictable universe.
Wow.
And historically, human beings will pay a very high premium for that comfort, even if the data continually proves that the order they are buying is a complete mirage.
To prove just how deep that mirage goes, Malkiel didn't just write out a series of dry academic equations in his book. He actually ran a practical experiment.
Yes, he did.
And this is one of my absolute favorite parts of this entire deep dive because it moves from economic theory into a brutal exposure of human hubris. He literally tested the experts with a coin flip.
The famous coin flip experiment. This is where Malkiel brilliantly bridges theoretical economics and behavioral psychology.
It's so good.
He wanted to demonstrate exactly how easily the human mind, even an incredibly educated, highly trained, highly compensated human mind, can be thoroughly fooled by randomness. So he decided to fabricate a stock price chart.
And crucially, he didn't use a computer algorithm to generate the data. He used a literal coin.
A simple physical coin. He started an imaginary stock at a theoretical baseline price, let's say $50.
Okay.
Then he sat down and flipped the coin. If it landed on heads, the imaginary stock price went up by half a point. If it landed on tails, the stock price went down by half a point.
So simple.
He did this over and over and over again, tracking the cumulative quote-unquote price on a piece of graph paper, manually drawing a visual chart of the coin's random journey over time.
So the resulting line that's jaggedly moving up and down on the chart has absolutely no underlying economic reality attached to it.
No.
It's not driven by a company's quarterly earnings. It's not driven by the CEO's management style or supply chain issues or global interest rates.
Right.
It is pure, unadulterated mathematical randomness disguised as a line graph.
Precisely. Now, Malkiel took this completely fabricated, randomly generated chart, and he quietly slipped it into a thick stack of real, historical stock charts from actual publicly traded companies.
This is devious.
He then presented this mixed stack of charts to a group of professional Wall Street analysts, the exact people whose entire highly paid job is to look at visual charts, identify actionable trends, and tell their clients what to buy.
Right. The experts.
He asked these professionals to analyze the charts and tell them what the stocks were going to do next.
I am almost wincing just anticipating the answer. How did the professionals react to the fake chart?
The professionals could not reliably distinguish the coin flip chart from the real stock charts.
You're kidding?
I'm not. They studied the random line with the exact same intensity as the real data. In fact, it gets worse.
How does it get worse?
One analyst looked at Malkiel's random coin flip chart, confidently identified a pattern, and reportedly told Malkiel to buy the stock immediately because the chart was showing a classic upward breakout pattern.
Oh my God, a classic upward breakout pattern on a coin toss.
The random fluctuations looked entirely real to the experts. They saw historical trends, they saw market momentum, they saw actionable intelligence in a series of completely meaningless coin tosses.
What's fascinating here isn't just the failure of the analysts, it's what this tells us about the hardware of the human brain.
Absolutely.
We are simply not wired to process randomness. We are evolutionarily wired to find shapes and patterns.
Have to be.
Right. We are the descendants of ancient hunter-gatherers who survived precisely by spotting the pattern of a predator hiding in the visual noise of the tall grass.
Yeah, that's exactly it.
We look up at the clouds, and our brains automatically assemble random water vapor into the shape of a face or an animal. We look at a series of random coin flips plotted on a graph, and our brain screams, "There is a pattern here. If I can just decode it, I can survive."
That evolutionary mechanism is called pareidolia. It's the psychological phenomenon of seeing meaningful patterns in ambiguous or completely random stimuli.
Pareidolia.
Yeah. It kept us alive on the savannah. But in the financial world, this cognitive bias is incredibly dangerous. Professional analysts fail to distinguish randomness from real market patterns because their brains demand order just like ours do.
Makes sense.
But there is a massive secondary layer to this, which is financial incentive. Their paychecks also demand that a pattern exists.
Oh, absolutely. You cannot justify a seven-figure salary and a massive fee structure to your clients if your professional expert analysis boils down to it's entirely random, I have absolutely no idea what happens next, and your guess is as good as mine.
You'd be fired immediately.
Right. You are deeply incentivized to find a pattern, so your brain obligingly provides one, even if you are just hallucinating structure into the void.
Yeah.
I try to imagine the visceral, gut-wrenching reaction of that analyst. Picture it. You are sitting in a mahogany office wearing a power suit. You've spent an hour deeply analyzing this chart, pointing out the support levels, the resistance bands, the momentum shifts.
Leaving a supremely confident recommendation to buy.
Exactly. And then a Princeton professor leans over your desk and says, actually, I drew that chart yesterday in my living room by flipping a quarter 50 times.
The cognitive dissonance must be staggering. I mean, it completely shatters the fundamental premise of their expertise.
It really does.
But rather than accept that their underlying methodology is flawed, the financial industry tends to double down.
Of course they do.
They invent even more complex charts, more sophisticated algorithmic indicators, trying desperately to find the signal in the noise. But Malkiel's experiment powerfully illustrates that sometimes there is no hidden signal. Sometimes the noise is just noise.
Okay, so if visual patterns on a chart are just an illusion, if they're just the financial equivalent of seeing faces in the clouds, then what exactly are these experts claiming to do all day?
Right.
Like, how do they justify their existence to investors? Because Malkiel doesn't just stop at mocking them with a coin flip. He systematically categorizes and tears down their specific methodologies.
He does. To understand the illusion, you really have to understand the tools they claim to use. Malkiel categorizes the traditional approaches to market analysis into two primary schools of thought, and then he meticulously dismantles the utility of both of them.
Okay, what are the two schools?
The two schools are technical analysis and fundamental analysis.
Let's start with technical analysis, because that ties directly into the coin flip experiment we just explored. What exactly is a technical analyst doing when they look at a screen?
So technical analysis is entirely focused on the price action itself. Technical analysts operate under the belief that all the fundamental information about a stock, the earnings, the management, the economy, is already perfectly reflected in its price chart.
Okay.
Therefore, they don't care what the company actually makes or does. They only study the geometry of the chart patterns.
The geometry.
Yeah, they look for support levels, which are prices where they believe a stock mathematically won't drop below, and resistance levels, prices it supposedly can't break above.
Right.
They use moving averages, trend lines, and complex geometric overlays to predict the next directional move based purely on past price shapes.
To bring in another analogy, it's like trying to predict the final score of a football game by meticulously analyzing the shape and depth of the cleat marks left in the mud at halftime.
Oh, that's exactly what it is.
You are obsessing over the residue of the action, the physical imprint left behind by past movements, rather than looking at the actual players on the field who are scoring the points.
That is a highly accurate way to frame it. You are studying the footprint instead of the animal.
Yeah.
And Malkiel's assessment of this methodology is decidedly blunt.
What did he say?
He explicitly compares technical analysis to astrology.
Astrology.
Yes. He argues it has no more reliable predictive validity than reading a horoscope in the Sunday paper. The patterns they identify, things they call head and shoulders formations or cup and handle pattern.
Cup and handle.
Yeah, they're just products of our pattern-seeking minds forcing narrative onto data. They are not meaningful predictive signals originating from the market.
Right, because of the coin flip.
Exactly. The coin flip experiment proved mathematically that you can find a perfect head and shoulders pattern in pure generated randomness. Therefore, executing trades based on those visual patterns is nothing more than financial superstition.
So technical analysis is basically reading tea leaves with an advanced degree.
Pretty much.
But then there is the second school of thought, fundamental analysis, and this one sounds significantly more rational. This is the stuff you actually hear about on serious financial news networks.
Yes. Fundamental analysis sounds much more grounded in reality. It involves examining a company's actual tangible economic value.
So they care about what the company does.
Yes, a fundamental analyst isn't staring at the squiggly lines on a chart. They are reading the quarterly balance sheets. They are analyzing cash flow, evaluating year-over-year growth rates, judging the quality and track record of the executive management team, and assessing the company's competitive position within its specific industry.
That sounds like a lot of work.
It is. They are trying to calculate the true, objective, intrinsic value of the company.
And the logic follows that if that intrinsic value they calculate is higher than the current price the stock is trading at on the market, they buy it because it's a bargain. And if the intrinsic value is lower than the current price, they sell it because it's overvalued. It makes total logical sense. Even Malkiel concedes that this is fundamentally more valuable than technical analysis, right? Like he acknowledges it's at least dealing with economic reality.
He does concede that point. Fundamental analysis is intellectually superior to technical analysis because it is rooted in tangible business metrics.
Right.
However, and this is the crucial, somewhat devastating pivot in his argument, He still argues that consistently beating the market through fundamental analysis is extraordinarily difficult, to the point of being statistically impossible for the vast majority of participants.
Wait, I need to push back here.
Go ahead.
Because if fundamental analysis is logical and it's based on real, verifiable economic data, why does it still fail to beat the market?
It's a great question.
If I do the hard work, read the balance sheets, and find a company with brilliant management, zero debt, and skyrocketing earnings, why can't I just buy that stock and get rich? It seems like hard work should equal reward.
In almost any other field, your logic would be flawless. Hard work and deep research usually yields superior results. But the stock market is a unique environment, and fundamental analysis fails as a consistent cheat code because of the underlying mechanism of the market speed.
With speed.
Yes, markets process and price in new information with remarkable, ruthless, almost unfathomable speed. You have to remember, you are not the only person doing fundamental analysis.
Okay, so if millions of analysts are all reading the same earnings reports at the exact same second, it sounds like a massive informational traffic jam. How does anyone actually get an edge?
They don't. And that traffic jam is actually the core of Malkiel's whole worldview. Imagine a highly successful company. They have phenomenal management, their earnings just doubled, their new flagship product is revolutionary.
Sounds like a great buy.
The problem is, everyone already knows this. Wall Street employs thousands of brilliant analysts whose sole dedicated job is to scour every single earnings report the absolute millisecond it is released.
Oh, wow.
Institutional investors use supercomputers and fiber optic cables drilled straight through mountains to scrape data and execute trades in fractions of a millisecond.
So by the time I, as a regular person, read that a company has great management, the value of that greatness is already entirely baked into the price of the stock.
Precisely.
Yeah.
If the fundamental data is good, the stock price is already high to perfectly reflect that goodness.
Right.
You aren't getting a secret bargain. You are paying a premium price for a known premium quantity. You cannot outsmart the market because the collective aggregated intelligence of the market has already processed that fundamental information and adjusted the price upward before you even had a chance to unlock your phone and open your brokerage app.
It's like trying to get a massive discount on a house in a neighborhood where everyone already knows the schools are top rated, the crime rate is zero, and a brand new high-speed train station is opening next week. The seller knows it, the real estate agents know it, all the other buyers know it, so the asking price is already sky high to reflect all of that positive news. There is no hidden, undervalued gem left for you to uncover by just looking at the neighborhood stats.
And this speed of information absorption, this ruthless efficiency of the market to process fundamental data instantly, leads us directly to the theoretical bedrock of Malkiel's entire book.
Which is?
Economists call that traffic jam of information processing the efficient market hypothesis.
Let's lay this out carefully because this is the concept that really turns the knife on the active management industry. What exactly are the mechanics of the efficient market hypothesis?
The efficient market hypothesis, or EMH, is the idea that stock prices at any given moment perfectly, instantly, and completely reflect all available public information.
All of it, without exception.
All of it. Every quarterly earnings report, every macroeconomic data point released by the government, every geopolitical rumor, every patent filing, every shift in consumer sentiment.
Wow.
If it is public knowledge, it is instantaneously incorporated into the price of the stock. Therefore, the hypothesis states no publicly available information can be consistently used to earn returns above what the market delivers as a whole, because you cannot act on information faster than the market can price it in.
Hold on, I have to play devil's advocate here.
Please do.
If the market perfectly prices in all information instantly, how do you explain the billionaires who clearly did beat the market?
Like who?
How do you explain a Peter Lynch or a Jim Simons with Renaissance Technologies? Or, for a more recent example, how do you explain meme stocks like GameStop, where the price clearly detached from any underlying economic reality and skyrocketed based on internet forums?
Right.
If the market is a perfect supercomputer processing fundamental data, why does it occasionally seem to hallucinate?
That is the exact right question to ask, and it highlights the nuance between average returns and statistical anomalies. First, regarding the billionaires. In a system with millions of participants making billions of trades over decades, basic statistical probability dictates that someone will beat the market by a massive margin just by sheer chance.
Just luck.
If you have 1 million monkeys flipping coins, one monkey's going to flip heads 50 times in a row. That monkey looks like a genius. They will probably write a best-selling book about their coin flipping strategy, but it's still just statistical variance.
Okay, what about Jim Simons?
Now, regarding Jim Simons, he used quantum mathematics and massive computing power to exploit micro-inefficiencies before anyone else could, essentially proving that the market is efficient for everyone else who doesn't have a supercomputer.
And the meme stocks. GameStop.
The efficient market hypothesis doesn't state that the price is always fundamentally correct in a philosophical sense. It states that the price reflects all available information, including the irrational behavior, the short squeezes, and the speculative mania of the participants.
Oh, that makes sense.
The price of GameStop was an accurate reflection of the massive, coordinated buying pressure at that exact moment. The market efficiently priced in the madness. But the core tenet remains. You cannot predictably use that information to beat the market consistently over a 30-year timeline.
I want to connect this directly back to the listener and the stark practical implications this has for the everyday investor.
Let's do it.
Think about your morning routine. You're sitting at the kitchen table, drinking a cup of coffee, and you're reading a financial news article on your tablet. The article says, Company X just discovered a breakthrough new technology. Earnings are expected to triple. Your immediate logical human instinct is, wow, I should buy stock in Company X right now to get in on the ground floor of this growth.
But the efficient market hypothesis tells you that you are entirely, hopelessly too late.
Too late.
The morning news is already stale by the time the digital ink dries. By the time that article was researched, written, edited, published, and reached your tablet over your morning coffee, the market has already priced that breakthrough in.
It's crazy to think about.
Institutional investors and algorithmic trading programs process that patent filing the millisecond it hit the wire, and they aggressively bought up the stock, driving the price up to perfectly reflect the new expected earnings. By the time you buy, you are paying the new higher price. You missed the jump.
The market is always faster than the individual. You aren't just competing against a few guys in suits in New York reading the same newspaper.
No, not at all.
You are competing against the aggregated, instantaneous knowledge of the entire globe. Millions of highly incentivized participants, armed with unlimited capital, all trying to find a tiny edge. And the EMH says they are collectively so good at finding that edge, they completely eliminate it for everyone else.
If we connect this to the bigger picture, the efficient market hypothesis is actually the great equalizer. It sounds intimidating, right? The idea of competing against global supercomputers and millions of analysts.
Yeah, terrifying.
But what it really means in practice is that the retail investor reading the morning paper has the exact same structural disadvantage as the Wall Street hotshot.
Wait, explain that. How are we remotely equal if they have fiber optic supercomputers and I have a tablet and a Wi-Fi connection?
Because the Wall Street hotshot supercomputer is competing against 10,000 other Wall Street supercomputers.
Ah.
They are locked in an arms race that cancels each other out. They digest the information so efficiently and trade against each other so rapidly that the resulting price is perfectly fair for everyone, including you.
That's fascinating.
The professional analyst cannot reliably beat the market any more than you can because all the public information they study is already priced in by their peers. They might win occasionally through sheer luck, just like the dart-throwing monkey, but they cannot do it consistently over the long run. The playing field is leveled by the sheer force of its own hyper-competition.
So we have this elegant academic theory from a Princeton professor. But theories and hypotheses are great for university classrooms. They are great for writing books and giving lectures. But finance is a cutthroat, brutal, real-world industry where billions of dollars change hands daily. How does this actually hold up when real money is on the line? How does Malkiel's academic theory survive contact with the actual world of high finance?
It survives incredibly well.
Yeah.
In fact, it is validated by the real-world data in ways that are deeply embarrassing for the active management industry.
How bad is it?
The data reveals a staggering, undeniable statistic. Historically, between 80% and 90% of actively managed funds underperform their benchmark index over the long term.
Let me just pause and highlight that. An 80 to 90% failure rate.
Yeah.
An actively managed fund is a mutual fund or a hedge fund where highly paid experts are actively picking which stocks to buy and sell, explicitly trying to beat the market average. And you are saying that historically, 80 to 90% of them do worse than if they had just bought every stock in the market and gone to sleep for a decade?
Exactly. And the key phrase to remember there is, especially after fees.
Ah, the fees.
active managers charge you a premium for their supposed expertise. They charge management fees, performance fees, internal trading costs. Even if an active manager works 100 hours a week and manages to eke out a tiny fractional advantage over the market through sheer effort, their fees usually eat up that advantage entirely.
So you're losing anyway.
The mathematics of their own compensation drags them down, leaving the investor with less money than a passive, unmanaged index fund.
But the ultimate real-world proof of this wasn't just a statistical study buried in an academic journal. It was a spectacular, highly publicized, very public challenge. Enter the world's most famous stock picker.
Warren Buffett.
In 2007, Warren Buffett placed a wager. And this wasn't a gentleman's bet for a nice steak dinner. He placed a highly publicized $1 million wager that no hedge fund professional could beat a simple, unmanaged S&P 500 index fund over a 10-year period.
It was a fascinating watershed moment in financial history. Buffett issued the challenge to the entire hedge fund industry. The supposed titans of finance, the masters of the universe who charge exorbitant 2 and 20 fee structures.
Wait, what's 2 and 20?
Meaning a 2% management fee and 20% of the profits. They charge that because they claim to possess the secret sauce.
Right.
A wealth management firm called Protege Partners stepped up and bravely accepted the bet. They selected 5 fund of funds, which is essentially a highly curated collection of what they believed were the absolute best, most elite hedge funds in the world. They were going to actively manage this portfolio, trade strategically, and absolutely beat the market average.
And Warren Buffett, what was his complex counter-strategy?
Buffett simply parked his money in a Vanguard S&P 500 index fund, a low-cost, totally passive fund that merely tracks the performance of the 500 largest publicly traded companies in the United States.
That's it.
No experts, no active trading, no adjustments, just the baseline market average. The bet ran from the start of 2008 to the end of 2017.
We have to talk about that specific timeline because that 10-year window is absolutely wild. It started in 2008, which means it immediately ran straight into the teeth of the global financial crisis.
Oh yeah, terrible timing.
The market completely collapsed. And then it included the subsequent historic bull market recovery. It tested every possible extreme market condition. So the masters of the universe actively navigating the storm versus a piece of passive paper doing absolutely nothing. What was the result?
The index fund won. And
Yeah.
it didn't just win by a hair, it absolutely crushed them. Over the 10-year period, Buffett's passive index fund averaged an annual compounded return of 7.1%. The elite, highly engineered, actively managed hedge fund portfolio selected by Protege Partners averaged just 2.2% annually.
2.2 versus 7.1.
Yeah.
So what does this all mean? The supreme irony of this event is just staggering to think about. Warren Buffett is arguably the most celebrated active investor in history. He built a legendary fortune specifically by picking individual stocks and buying companies. Yet, he is the one who provided the ultimate, devastating, real-world validation for Burton Malkiel's passive investing theory.
The irony is profound, but it's consistent with Buffett's worldview. Buffett himself has frequently stated that while he has managed to beat the market, which we must acknowledge is a rare statistical anomaly, often driven by his ability to buy entire companies and change their management, he recognizes that the vast, overwhelming majority of investors, both amateur and professional, absolutely cannot replicate what he does.
So he knows he's the exception.
Exactly. By issuing that bet, Buffett was publicly demonstrating that for almost everyone else, the efficient market hypothesis holds true. To give you some granular detail on why the hedge funds lost, in 2008, during the crash, the hedge funds actually did slightly better than the index because they could actively short stocks and hedge their bets.
Okay, so they won the crash.
But during the 9-year bull run that followed, their massive fees, combined with the cash they held on the sidelines waiting for the right time to buy, completely obliterated their ability to compound wealth. The sheer drag of fees means that simple passive indexing will almost always triumph over complex active management over a long time horizon.
Let's just sit for a second with the existential dread this must cause in the hedge fund industry.
It's got to be rough.
You have multiple Ivy League degrees, you work 100 hours a week, you build quantum algorithmic trading models, you convince your clients to pay you astronomical fees, and the greatest investor of all time publicly, undeniably proves that a simple, cheap, unmanaged index fund that a teenager could buy on an app will crush your highly engineered portfolio over a decade. It's a devastating indictment.
It is an indictment that the industry still tries very hard to ignore or explain away with marketing spin. But the numbers are incontrovertible. The bet proved that Wall Street's promise of superior returns through active management is, in the vast majority of cases, an illusion heavily subsidized by the client's own fees.
Okay, so we've established the problem in vivid detail. We've seen how the pros are fooled by random coin flips. We know the charts are essentially financial astrology.
Yeah.
We know the market's information absorption is too fast to beat, and we know Warren Buffett proved the experts usually lose to the average. Since we now know that paying experts to pick stocks is a mathematically losing game, we need to talk about the solution. What is the actionable blueprint for the listener? How do you actually win this game if you can't predict the future?
Malkiel's central recommendation is where the book shifts from a harsh critique to profound, empowering, actionable advice. The solution he offers is elegantly simple. Buy low-cost index funds and hold them for a very long time.
Let's define an index fund functionally for the listener. How does it actually work?
An index fund, like a total stock market fund or an S&P 500 fund, does not try to pick winners and losers. It does not employ analysts to read balance sheets. It simply buys all the stocks in a particular index, usually weighted by their market capitalization.
Okay, give me an example.
So that means if Apple makes up 7% of the value of the S&P 500, 7% of your money goes into Apple. If Wendy's makes up a tiny fraction of a percent, a tiny fraction of your money goes to Wendy's. It just passively tracks the entire market.
So no one is actively managing it.
Because it doesn't employ highly paid analysts or trade frequently, it is incredibly cheap to run. Instead of trying to beat the market, you guarantee that you match the market. And as we've learned from the statistics, simply matching the market average is enough to beat 80 to 90% of the highly paid professionals.
Malkiel unpacks this passive strategy into 4 practical principles for the everyday investor. Let's walk through them carefully, because this is the core takeaway. Principle number 1, minimize costs. And I want to slow down and really explain the math here, because people hear the word fees and they think, oh, it's just a percentage point, no big deal. What's 1%?
It is a massive, life-altering deal. The compounding effect of fees over time is the silent killer of generational wealth. The source material highlights the staggering difference between a 1% expense ratio, which is typical for an actively managed mutual fund, and a 0.1% expense ratio, which is typical for a passive index fund.
A 0.9% difference. To the human brain, that sounds like nothing. It sounds like pennies on the dollar.
It sounds like nothing, but let's walk through the exact math. Imagine you have $100,000 invested, and the market is completely flat for the year. It doesn't go up, it doesn't go down. An active manager with a 1% fee still takes $1,000 directly out of your account just for existing.
Right.
An index fund takes $100. That $900 difference is money that is physically removed from your account. But the real damage is over a 30-year investment horizon. Because of the math of compound interest, that 0.9% doesn't just reduce your final return by a little bit. It radically alters the trajectory of your wealth.
How bad does it get?
Over decades, you aren't just losing the fee. You are losing all the compound growth that money would have generated if it had stayed in your account. That tiny 1% fee can consume tens of thousands or even hundreds of thousands of dollars of your potential retirement wealth. You are sacrificing a massive portion of your life savings simply to pay the salary of a manager who, statistically, is going to underperform the market anyway.
Let me upgrade my earlier analogy. Imagine you are running a marathon. You are a great runner, you've trained hard, you have good shoes. But the rules of the active management race say you have to run with a 50-pound backpack strapped to your shoulders.
That's a good way to look at it.
That backpack is the high expense ratio. You might run a good race, you might even have a great mile here or there, but the sheer, constant, unrelenting weight of the fees guarantees you will eventually fall drastically behind the person running unburdened in the passive index lane.
Exactly.
The unburdened runner doesn't have to be faster, smarter, or in better shape. They just have to keep moving forward without the mathematical drag pulling them down.
That perfectly captures the mechanics of it. The second practical principle Malkiel outlines is to diversify broadly. He emphasizes using broad index funds over individual stock picking. Even if you completely ignore the professionals, you shouldn't try to be your own active manager either.
Why not?
Buying a single stock exposes you to severe company-specific risk. A CEO could commit fraud, a flagship product could be recalled, a competitor could disrupt their entire business model.
And then you lose everything.
By buying a broad index fund, you spread your risk across 500 or even several thousand companies. You capture the overall unstoppable growth of the global economy while completely minimizing the risk of a single corporate failure destroying your portfolio.
Which leads directly to principle number 3. Stop trying to time the market. This is huge, and it's the hardest pill for people to swallow. Whenever I talk to people about investing, they always want to know, is now a good time to buy? The market feels high. Should I wait for a crash? Should I hold my cash?
Malkiel is absolutely emphatic about this. You cannot predict the market's short-term movements. Trying to time the market selling when you think it's at the peak and holding cash waiting to buy when you think it's at the absolute bottom is a fool's errand.
Why is it so hard?
To successfully time the market, you have to be right twice. You have to know exactly when to sell, and you have to know exactly when to buy back in. No one does that consistently. If you pull your money out waiting for a crash, you usually end up missing the biggest days of the recovery, which permanently cripples your long-term returns.
So what's the functional alternative? How do we invest without trying to guess the weather?
The alternative is a mechanical strategy called dollar cost averaging. You invest a set amount of money regularly, say $500 every single month out of your paycheck, completely regardless of what the market is doing.
Just blind consistency.
And here's the mathematical aha moment of why this works. When the market is high, your $500 automatically buys fewer shares. But when the market crashes and everyone is panicking, your fixed $500 automatically buys more shares on sale.
Oh, that makes sense.
You don't have to think about it. You don't have to predict anything. Over time, this mathematical mechanism naturally lowers the average cost of the shares you own. Consistency beats prediction. You completely eliminate the emotional stress of trying to guess the right moment, and you let the long-term upward trajectory of the human economy work for you.
And that brings us to the fourth and final principle, which I think is actually the most difficult one psychologically. Think in decades, not days. We need to spend some real time on the psychology of this.
Definitely.
Because logging into your 401k during a major recession, watching a third of your net worth evaporate in red numbers, and doing absolutely nothing, that takes a toll. It is emotionally grueling. If you are checking your portfolio balance every afternoon on your phone and stressing over a 2% daily drop, you are playing the wrong game.
You are. The random walk theory explicitly says the short term is nothing but noise. The daily fluctuations are unpredictable, random walks driven by immediate news and human emotion. But over decades, the stock market ceases to be a casino and becomes a weighing machine.
A weighing machine.
It reflects the genuine underlying growth of the human economy. Corporate innovation, global population growth, massive productivity increases driven by technology. These fundamental forces drive the market higher over a 30-year timeline. If you think in decades, the daily noise, the recessions, the corrections, they all become irrelevant blips on a long-term upward curve.
But it's hard to hold on.
Holding through the panic requires immense discipline. During the 2008 crash, the people who panicked sold their index funds at the bottom and held cash waiting for things to feel safe again missed one of the greatest bull market recoveries in history. The people who gritted their teeth, ignored the news, and just kept dollar cost averaging every month recovered their wealth infinitely faster.
This raises an incredibly important question, though. Everything we've just discussed, the math of compound fees, the failure rate of the experts, the sheer elegance of dollar cost averaging into index funds, it is entirely logical. It is backed by 50 years of hard empirical data. So why is it so incredibly hard for people to accept this advice? Why do smart people still chase the hot stock tip from their brother-in-law?
It's because low-cost indexing requires surrendering the ego. It requires looking at the vast complexity of the global economy, looking at all the brilliant analysts, and actively admitting, I cannot outsmart this system. I am not special enough to predict the future. I do not have a unique insight.
That's tough for people.
That is a very bitter, uncomfortable pill for human beings to swallow. We want to be the hero of our own financial story. We want to find the hidden gem, the diamond in the rough, the next apple before it explodes. Accepting the efficiency of the market means consciously accepting average returns.
Even if the average is better.
Now, ironically, because of the drag of fees on everyone else, accepting the mathematical average actually places you in the top tier of all investors over a 30-year period. But it doesn't feel glamorous. You can't brag about an S&P 500 index fund at a dinner party. Wall Street thrives on our ego and our desire to be exceptional. Malkiel asks us to abandon it entirely.
It's like we desperately want investing to be an action movie with explosions and last-minute saves, but the most profitable strategy is actually closer to watching paint dry, taking a nap, and waking up 20 years later.
Exactly.
Yeah.
Good investing should be profoundly boring. If you want excitement, if you want the thrill of the gamble, take $1,000 to Las Vegas. But if you want to secure your retirement and build generational wealth, buy a low-cost, broad market index fund, set up automatic monthly contributions, and quite literally do not look at the balance for 20 years.
We've covered a tremendous amount of ground today. We started with a monkey throwing darts at a wall, and we've navigated through some truly paradigm-shifting ideas about how money actually works. We've seen how a simple coin flip can brutally expose the cognitive biases of the most highly paid professionals in the world.
Yeah, that experiment is wild.
We've unpacked the mechanics of why technical analysis is little more than finding shapes in the clouds. We explored the ruthless, hyper-efficient speed of the market where information is priced in before you can even react. And we saw Warren Buffett himself prove, with $1 million on the line, that a simple, cheap index fund is the ultimate wealth-building tool, capable of crushing the masters of the universe simply by refusing to play their game.
A Random Walk Down Wall Street is fundamentally a book about reality. It systematically tears down the comforting, expensive illusions sold by the financial industry. It isn't a book designed to make you feel clever, and certainly doesn't give you a secret formula for overnight riches. It's a book designed to make you wealthy through the profoundly unsexy virtues of mathematical simplicity, intellectual humility, and extraordinary patience.
And I think that is incredibly empowering. I want to remind you, the listener, you do not need a Wall Street pedigree to secure your financial future. You don't need to understand complex algorithmic trading, you don't need to spend your weekends reading obscure corporate balance sheets, and you don't need to pay a guy in a suit 1% of your wealth every year to guess the future for you.
Absolutely not.
The market is efficient, which means you are entirely freed from the stressful, impossible task of trying to beat it. You just have to participate in the overall growth of the economy, minimize your costs, and let time do the heavy lifting. In this game, simplicity is your absolute superpower.
But as we wrap up this deep dive, I want to leave you with a final, lingering paradox to ponder on your own. It's a theoretical puzzle that builds on everything we've discussed today regarding efficiency.
Lay it on us.
We established that the market is highly efficient, specifically because thousands of active analysts are furiously researching, buying, and selling, instantly pricing in all new public information.
Right.
Their hyper-competitive, active trading is exactly what creates the accurate prices that make the market efficient for the passive indexer to just blindly buy. But here is the paradox. If Malkiel is entirely right, and the market perfectly prices in all information, what happens in the future if every single person on Earth reads this book, fires their active managers, and only buys passive index funds?
Oh, wow.
If absolutely no one is actively researching balance sheets and no one is buying individual stocks anymore, if everyone is just blindly buying the index, who is left to actually do the work of setting the efficient prices?
The ultimate brain teaser. The passive system inherently requires a large group of active people to be wrong and to pay high fees in order to work perfectly for the passive people who are right. Something to chew on while you happily ignore your portfolio for the next decade. Thanks for joining us on this deep dive into the random walk. See you next time.
So, friends, that was the complete breakdown. Make sure to take a screenshot of this growth gift, this infographic, so this lesson stay with you. If you want to learn from legends every single day, join our community. I am Amin. Always remember, read more, think deeper. Let me know in the comments who we should cover next. See you in next episode.